Welcome. You're watching Trading Hour. I'm Ritu Singh. With me is my colleague Manglam. Hi, Manglam. It's good to be in the Mumbai studio. It's been a very volatile day of trade after that downfall we saw in the markets yesterday. Bit of a recovery, but still now we're at 62 points down on the Sensex, 60 points down on the Nifty, and the Bank Nifty is broken below the 58,000 mark as we speak. Now at 57,996. A market breadth firmly in favor of declines.
Market breadth firmly in favor of declines. In fact, what happened is that 11 a.m. That's when the FIIs start coming in, or the initial trades get settled in, and that's where we're actually seeing a fair amount of selling. So this morning it was volatile. Yes, we opened marginally in the red, and thereafter we saw an immediate recovery for the market as well. But then, as we speak, the Nifty is down about 60 points, below that 24,800 mark as well. The Sensex not doing particularly well. The mid-cap index, the market breadth out here tells you the story of the day. 2,151 stocks declining for about 681 stocks which are advancing itself. The other thing that I'm looking at right now is, two packs in particular. One is the railway pack, the other one is the defense pack. So yesterday, we saw a sharp knock on all these stocks. And now if you look at some of these railway stocks, they are seeing another round of selling because maybe the street was expecting a little more coming in for some of these counters in the budget. Yes, there has been a 20% plus increase in defense capex, but is that enough given the valuations at which these stocks were trading despite the collection? Perhaps not. The defense industry is down about 1.5%. Individual stocks, something like a Bharat Dynamics or BEL, down a lot more than that. Bharat Dynamics is the one that should come up for you. Alongside that, we are also seeing a bigger gash on a few of these NBFCs, the likes of Shriram Finance, etc. That's the top Nifty loser right now. Down 4% is the gross borrowing number worrying the street, especially on the NBFC side or not, is something that we will monitor very, very closely. So yes, yesterday's verdict from the market standpoint for the budget was fairly clear that we have seen a decline. Today, the street was hoping for some sort of sensibility to pick in some rationality. And now, as we speak, the market has been, declining for a while right now. So, well, as we speak, the Nifty around that 24,750 mark. The one level that we have to track very, very closely is most definitely yesterday's low, which is just around that 24,500 mark, little below that, 572 or 472 thereabouts. So that's a level that we will be tracking, but we are seeing a fair amount of sell-off. Ritu.
Fair amount of sell-off indeed. Manglam, thanks very much for running us through how the market's doing the day after the budget and the surprise with the STT and the borrowing number really bothering the markets. We have to take a short break though. We'll slip into that. And when we return, we'll get you more on the markets and continue our stock-specific budget coverage as well in just a bit. Welcome back. Brigade Enterprises is the first management on our radar today. The company's bookings have declined sequentially while realizations have grown during the quarter. The occupancy, however, declined as well. To discuss the numbers for the quarter gone by and the way forward, we are now joined by Pavitra Shankar, the MD of Brigade Enterprises. Pavitra, thanks very much for your time here. Bookings and volumes are both down, and that's contrary to the commentary we've been hearing from the likes of Puravankara as well as Prestige. Is there a sector-specific slowdown you're starting to see, or you think it's a more Brigade-specific issue?
Hi, good morning. Thanks for having me. The numbers that we're seeing this quarter is predominantly for Brigade due to some of our launches being pushed out into Q4. Apart from that, we don't see any major changes on ground. Over the last year or so, we've been seeing the demand shift more towards premium housing, where the absorption has been more of a stabilized manner instead of a very rapid absorption that we saw over the last few years as there was a pricing discovery going on. So we don't really see anything major in terms of on-ground effect other than the pricing increases over the last few years within our portfolio and overall in the industry in general that had gone up substantially, driving up ticket sizes as well. So we're seeing a stabilization of that demand across all our markets, Bangalore, Chennai, and to an extent Hyderabad, which is still able to absorb fairly high ticket sizes.
So does that mean this 15 to 20% sort of bookings growth guidance that you had given for the full financial year stays? And since you spoke about ticket prices, you had taken price hikes around 5 to 10% across your projects. Were they absorbed easily, or maybe there was some push here?
So yeah, for the ticket sizes that we're talking about and the price increases, they have been absorbed well. It's a mix of price hikes in the existing projects as well as new projects that get launched in the course of the quarter or in the course of the year. But our our outlook has been that pricing when we launch the project is coming in at the right expectation for customers as well. So we're not trying to take it up substantially beyond that as well. So we're still able to meet our profitability requirements for each project. In terms of the end of year numbers, the dependency is still heavily there on launch. I think that has been part of the narrative for the last few years for us and industry. A lot of the numbers tend to be back-ended in the second half of the year. Some of the launches that we would have wanted to see in Q3 have slipped into Q4. But on ground, the demand is not a cause for concern. It is just about timing and getting the approvals on time and being able to get those numbers related to that.
So you're sticking to 15 to 20% kind of a target despite the 9-month decline that we've seen where bookings are down 15%, or do you think you may need to revise that guidance?
Again, the numbers that we hope to do every year are heavily dependent on launch. If I don't get the approvals for some of the launches that we're expecting to do in Q4, we may not be able to make that number. So again, as I said, it depends on those approvals coming through because we are seeing about 50-50 contribution in our projects, in our numbers from existing projects and new launches. That's what we've seen over the last 9 months. But a large part of our achievement for Q4 will come in from launches. So the guidance, so to speak, will depend on that.
So what's the launch that you've earmarked for the fourth quarter? Because I see, and our director will fire that as well on the graphics plate. 1.2 million square feet is the projected launch that you have, planned launches over the next 4 quarters. So what's the kind of launch pipeline that you have for the next couple of quarters where you have visibility at least?
We are hoping to do about 4 to 5 million in the next couple of quarters. And ideally, the bulk of that will come in Q4, barring which we will have a bit of a challenge in terms of doing sales, obviously, from new projects. But existing projects are all selling well, and we're still seeing good traction in terms of those.
Okay, you don't really have multi-geography exposure for Brigade, so to speak, to protect yourself from downturn, especially in what we've been seeing in the NCR region, etc. Is that something you want to focus on going ahead to diversify geographically a bit more?
So we are present in Bangalore, Chennai, and Hyderabad. Those are 3 major cities in South India. We're currently not necessarily looking at the NCR market. And I think the 3 markets that I just mentioned are fairly well diversified. Yes, they're all in South India, but they're all very strong markets and have been doing well. And in the past 2 to 3 years, our ability to get good business development and sign up good projects in both of those and launch projects has shown that we are able to do that. And we so far have been focusing on South Indian markets.
All right, just a couple of questions before we let you go. Pavitra, the launch of 3 million square feet in office assets next year. What will the capex be here, and what do you eventually expect the annuity to be from the office sector for you going forward? That's one. And second is on your construction costs. They've increased from what, 1,800 crores to about 2,300 crores in the first 9 months of this year. Is this because launches got delayed and that's why the revenues didn't show up, or is there something else that you could explain where the cost has increased but not shown in the revenue so far?
So on the construction cost, the cost has gone up because of the number of projects that we're doing, and that has increased substantially. On the revenue side, because we follow the Ind AS accounting method, the revenues will come in at the completion of the project. So that's where we see a bit of a time lag. There is no issue in terms of how much more we are spending in that sense, whether it is residential or commercial. Our costs are in line. In terms of our office portfolio, we have about 9 office projects with around 1,600 crores of estimated capex. We are hoping to get our current portfolio is about 1,500 crores in terms of leasing revenue, and we're hoping to grow that to maybe another 2,000 crores in the coming years ahead.
And that is when you plan the REIT or separation of that business or value unlocking out there?
Yeah, we'll definitely be examining that based on the top line.
So that happens in the next couple of years?
These projects have to get built out, leased up, and then we will take a call accordingly.
All right, take that point. Thank you so much for joining in and giving us an outlook to your business. The fourth quarter obviously depends on the launches, the sort of bookings growth that you've earlier guided for, whether you get those approvals in time or not. But over the next 4 quarters, 12 million square feet worth launches are planned. And 4 or 5 million, of course, realistically could happen in the next couple of quarters itself. Meanwhile, just looking at the market right now, the Nifty is down 90 points. So there is an accelerated shift on the way down, which is taking place. At any point in time in the last 20 minutes or so, one would have shorted, they would be making a fair amount of money. But let's shift focus to the bond link and let's figure out what's taking place in that part of the market as well. Is the street a little worried? The bond market action, Manisha Gupta joins in as always. Manisha.
Well, thank you so much for that. On Bond Street today, we are talking about the bond markets and the kind of impact that we've seen come in from the budget onto this one. So the last couple of days, really, we've seen the bond yields continue to gain up. The 10-year yield is currently trading at a 1-year highs as well. There was an expectation of higher borrowing program from the government, and that's exactly what you have seen. Higher capital expenditure and higher borrowing program. So when you look at FY27, the government will borrow a record rupees 17.2 lakh crores, which is 18% higher on a year-on-year basis. There have been concerns on debt supply and liquidity conditions in any case. There also has been a fear on demand-supply imbalance into the bond markets there. Also, when you look at the heavy issuance that we've seen from the center and the states and the weak demand therein, that has been impacting the bond and the yields therein. The government also is planning to raise a 1.3 trillion via treasury bills. That seems to be impacting markets right now. Also, when you look at the Indian rupee, we've seen a 2% decline in the month of January. There are adverse global backdrops as well, pushing the yields in the Indian markets higher. So while that is about spending and what's really happening in the international cues and macros therein, the budget also talks about steps to broaden the participation and improve long-term funding options when it comes to within the segment here. And that perhaps is going to be positive going forward. So to name a few, it's going to be a 100 crore incentive for a single municipal bond issuance exceeding rupees 1,000 crores therein. It will encourage larger and, of course, cities to raise funds through the bond markets therein. There also is introduction in the meanwhile of total return swaps on the corporate bonds. And then the Finance Minister, Nirmala Sitharaman, also spoke about market-making framework, especially for the corporate bonds. So some positives as well coming in from the bond markets from the budget therein.
Manisha, thanks very much for bringing us that. Though positives on the bond market development, Mangalam, not so good for the banks, where incrementally some of the credit has been shifting to the bond market. So perhaps an incremental negative there. And of course, the hit from the Treasury book because of yields rising. We'll take a short break, but up next, we'll get chatting with the management of Arvind on their third quarter numbers. So stay tuned.
Welcome back. The Nifty down 120 points now, on the verge of breaking that 24,700 mark as well. The Nifty Bank down almost 1%, with the mid-cap index lower by 670 points. Important corporate conversations lined up for you on the show, and now we have the management of Arvind Limited joining in, especially after the big announcement that came in from the budget yesterday, where the finance minister did say that they have been making plans for textile parks and increasing the skilling, etc., integrated textile program outlay of close to around 1,500 crore rupees. Will this actually make a dent? What kind of impact will it have on the sector? Puneet Lalbhai, who's the vice chairman at Arvind, joins in. Thanks a lot for joining in. There is this national fiber scheme which has been announced alongside the announcement of mega textile parks, etc., the outlay of almost 1,500 crore rupees. Puneet, in the past, we have seen announcements like this come by. Do you think this one is any different from those and will make a difference to the sector, which is currently under a bit of uncertainty, especially given the sort of geopolitical, tariff-related uncertainty that we're facing right now?
I feel the government has been doing quite a bit around sort of creating good conditions for the industry. And this announcement is one more step in that direction. If you see the importance is to grow the ecosystem in India, especially around garment making. And I think these mega textile parks are definitely a step in the right direction. And that coupled with the sort of FTAs that we have been able to close, the advantage of which will start to accrue sometime down in the future. I think it's definitely a step in the right direction, and I'm quite optimistic about all the efforts that the government has been making. And now it's up to the industry to take advantage and bat on the front foot.
But Puneet, could you put specific numbers in terms of how much of a benefit does this really bring? Because as Mangalam was saying, these have been announced in the past. We haven't seen it translate meaningfully into positives for players like you. And secondly, you said in the near future these FTAs will start to show benefits. What is that near future? Because the headwind currently for you is the over-dependence in the US market. How quickly do you think you could diversify, and what could the mix look like, say, 3-4 years down the line?
UK and Europe are very important markets for us right now. They comprise close to 8-9% of our overall turnover today. And going forward, we should be able to double our presence in these markets. So it's not an insignificant announcement for us, the FTAs. And the FTAs are under a ratification process, which takes time. I mean, in the case of other countries' FTAs also, it's taken time with these two geographies. So there's no reason to believe that the benefits won't accrue. And I think FTA is a very big deal because it's almost 10-12% in a net 6-7-8% business overall, right? So, the other announcements will pale in comparison to the benefit that one gets through FTAs. So we are very optimistic about the future. And historically, India has been an upstream textile player, playing mostly in yarn and fabric. And it's only now that we are seeing investments go into garments. And some of these major reforms were required and have been made. So I think the government's done its part, and I'm quite optimistic about the future.
All right. Can you put some numbers to the optimism then? If you look at the third quarter, your revenue is at around 1,800 crores. We did see some... your margins saw a bit of an impact, stable at around 11.5%, but not a big growth that we saw out there. What's your outlook for the next year?
So I would say this was a very good result in the context of all the trade uncertainty. We grew by 14%. Our EBITDA actually grew by 15% year on year. So overall, the if you look at the advanced materials business, that has shown very good traction. We grew at almost 30% quarter on quarter. Garments is up 22%. So overall, it's been a good quarter for us. And despite the headwinds, we see good traction in demand. So we should be able to continue this kind of trajectory going forward.
All right. If these tariffs, let's say we haven't heard more on the deal yet, if they persist through FY27 for a few more quarters, what kind of pressure do you think you could see, especially when it comes to the margin trajectory?
So I think we have currently achieved a balance to where, we've passed on discounts in lieu of additional volumes. We have done a lot of work on saving cost. And then there is the dollar that has worked in our favor, which is also linked somewhat to these uncertainties. So all in all, we should be able to continue this trajectory even if tariffs remain where they are. And then, of course, there is a very strong effort to diversify our dependence from the tariff-impacted markets, which is an effort that is slowly and surely yielding fruit. So all these things put together, we can be cautiously optimistic. But as you rightly say, in the face of these uncertainties and changes that continue to occur, one has to always factor that risk in. But so I would say it's a mood of cautious optimism going forward as well.
Got that. Take that point. Thank you so much for joining in. Wish you good luck, and we'll obviously monitor the changes that this budget brings about in the sector as we look at the free trade agreements that we sign as well. But the market's sharply off highs, and that's where the trends from the F&O space come in as well. You have the Nifty, the Nifty Bank, the mid-cap index, all of them at the lows of today's trading session. The advanced decline tells you a story of the day as well, with over 2,000 stocks in the red. The important part is that despite this decline, the India VIX is relatively stable, and the put-call ratio, which was at 0.59 yesterday, is now holding at around 0.74. So those two factors doing a lot better for the market than it was yesterday. Let's see whether there is support at these levels or not, because there are writers at the 24,700 put and there are writers at the 24,800 put as well. If the market sustains at these levels, those writers will have to unwind their positions, and that would take the markets a lot lower than what it is right now. Though call writers are fairly active at 24,800, so that tells you that any level above 24,800 would see a fair amount of supply coming in. So the key Nifty levels to track then would be yesterday's low of 24,571 and today's high of 24,943. So this broad range of around 300 points is where the market is likely to move and stay choppy, but those are important levels to track as we speak. Take a short break, come back on the other side. We'll get chatting with the management of Motherson, but before that, we'll also discuss the market outlook. Gautam Duggar of Motilal Oswal joins in. Welcome back. The market's under pressure, but we are discussing the after effects of the budget. The analysts, the experts, all of them have passed through all the fine print, and now we need to know whether there is any actionable idea that has come in from the budget or not. Gautam Duggar of Motilal Oswal Financial Services joins us now. Gautam, always a pleasure speaking with you. You've been tracking the Nifty earnings very closely. Each component, tweak them, speak about valuations, etc. Was there anything in the budget that caused you to, tweak those estimates and perhaps come up with any actionable ideas, or is it still more of the same?
Hi, Mangalam. Thanks for having me here. No, absolutely. We didn't need to do any change to our earnings estimates, and that's never been the case actually for the last 4 or 5 years. Typically, budget doesn't make big changes to sectoral earnings. Budget is more a top-down sort of a policy statement. We don't even expect budget to change our earnings materially, unless there are cases where government had reduced the corporate tax rate 6-7 years back. That was when we needed to make big changes to our earnings. But otherwise, it's very peripheral. And given yesterday's budget, I don't think there is too much sector level changes as far as Nifty is concerned. Of course, there are several sectors which have seen some initiatives and announcements, but that's more bottoms up rather than it leading to any meaningful changes in our earnings estimates for the benchmark indices.
Okay. Gautam, you said the budget was a missed opportunity to perk up the markets. What was the biggest disappointment for you? And if that STT coming in, does that meaningfully change your view on, the outlook for exchanges, for brokers? Any revisions there?
So, look, there are two ways to look at it. We didn't have too much of expectations from the budget to begin with, which is what we had published in our preview, which we did 2-3 weeks back for budget. You can just assume that instead of August or September, if the government had done the GST cut in the budget, perhaps the budget headline would have been very different. STT raise did come across as a sore point. Not that it's going to have any meaningful change. Of course, the market reacted in a different fashion yesterday to some of those broking stocks. From what we understand, it's going to have some impact on the futures volume, but options volumes are not going to see any meaningful change out there. Some of the future volume may shift to cash or more options. We'll have to see as we move forward. But the stocks, the way they've corrected, some of them have become quite attractive now. A couple of them are in our model portfolio. We're quite positive. We're very sanguine on the capital market themes in India, notwithstanding the near-term volatility that it will, entail, because the cyclical stocks and the sentiment in the capital market plays a huge role in the near-term stock price direction of some of these companies. But the story from a medium-term perspective remains extremely solid, not just broking and exchanges, but even the other elements of the capital market ecosystem, which is the asset management companies, the wealth managers, the intermediaries, the depositories. So we have an overweight stance on that space in our model portfolio.
Right. There's one name to the game. It's called volatility. The Nifty is back in the green right now. The Sensex too is back in the green. After testing levels of sub 24,700, the Nifty is now back above 24,800, and all in a matter of last few minutes. The Nifty Bank, which was down 700 points just moments ago, is now down just 380 points. So that's how volatile this market has been. And we were pointing out that despite the decline that we saw, the India VIX was fairly contained. So that told you that the downside perhaps may have been limited. So now the market's tested the lower end of the range. Let's see whether the upper end of the range gets tested or not as well. The rupee weakening from today's high of 91.4 thereabouts. It's weakened further to around 91.7. Gautam, markets are mainly moved by earnings, and we're in the middle of the third quarter earnings season. What have you made of the numbers so far? How do they track versus your expectations? And any meaningful upgrade or downgrade that has come by?
No, Mangam, look, for our coverage universe, out of 355 companies, about 189 companies have reported numbers. For those 189 companies, the numbers are bang in line. Earnings are up 14% versus expectation of 13%. And for the Nifty 31 companies which have reported so far, the earnings are up 7%, which is also in line with expectations. There are several sectors which have done well, auto, capital goods, the NBFC cohorts, metals, even retail for that matter. Consumer staples at about 10-12% earnings growth is at a multi-quarter high number. So a lot of these things are getting ignored given the other extraneous considerations which the market is right now grappling with. I think once the budget is forgotten in 2-3 days, the focus will shift back towards corporate earnings and fundamentals, and which is where the picture is turning slightly brighter. In fact, the pace and intensity of the earnings downgrade has also come off, which is what we'd highlighted a month back in our note. Even this quarter, as we progress, we've seen only about 0.3-0.4% kind of earnings cut. So the 15 to 17% earnings growth estimate that we have for FY27, and I'm sure skeptics will have arguments on that, and rightly so. But as of now, it is intact. We are still talking about a 16-17% earnings growth for Nifty in FY27, which essentially makes Nifty now below 20p at 24,700, the level that you mentioned a couple of moments back. So I think valuations as far as large caps are concerned are now in a territory which one may not call screamingly cheap, but it's quite reasonable now. It's trading at a long period average, which is 20.5 times. We are now at 19.6 to 19.8 times. So marginally below 20p. So yeah, I mean, earnings are turning slightly better, which is what the expectation was. The second half of FY26 will have better numbers given the low base and some of the positive impacts of the steps that the government and RBI have taken in the last 9 months, which is the GST cut, rate cut, interest, income tax cut, all of that. So that is manifesting in the numbers right now. And we are quite constructive on earnings for FY27 as we expect even the credit growth to start picking up a little bit from where we are right now.
All right, we'll watch for all of those cues as the market, the budget noise drowns in the next 2-3 days. Gautam, thanks very much. Always a pleasure to have you on the show. We have to take a short break, but up next, we're going to be joined by Anurag Gehlot of Motherson Sumi Wiring. Stay tuned for that. Motherson Sumi Wiring is the next management we have joining us on their third quarter numbers. The company's revenues have risen 25%, but margins have declined over the past year. Anurag Gehlot, the Chief Operating Officer of Motherson Sumi Wiring India, is with us. Anurag, welcome. Thanks for your time here. Copper prices have we been seeing elevated levels. The rupee, again, has weakened. How much further pressure should we expect in the fourth quarter numbers from you?
Hi, good morning. Thank you for taking us on CNBC. Yes, as you have seen that this is the highest ever quarterly revenues driven by the strong industry growth and increased content per car in the automotive industry. Having said that, we have grown 10.5% EBITDA year on year, though we are seeing a sequential margin pressure, and this is due to the rising commodity prices, and copper is one of the commodity in our cases. But we have the back-to-back arrangement, the pass-through arrangement with the customer, with a lag of a quarter in the major customer and on 6 months for the rest of the customers. So this is not something which is very much worried to us at this moment, because we have this customer contract in place where we have pass-through arrangement with them on the commodity as well as on the forex fluctuation.
So how much lower can margins go before they start stabilizing? You said it goes with a lag of a quarter, right? Between the second quarter and the third quarter, there's been a big spike in the copper prices, and not just that, even the rupee has depreciated, right? So how much is the headroom available right now?
See, as I explained you that we have grown, the margins with year on year by 10.5%. There is a sequential basis. There is a little pressure which we are seeing, but we are not worried because this is a arrangement with the customer back to back. But as a company, we believe in doing the ROCE. Our target is more than 40%, and happy to tell you in last 3 years. We are doing more than 40%. This year also in last 9 months, we are on track. And by the Q4 end also, you will see that the positive, more than 40%, subject to what customer is going to manufacture, what they have forecasted to us.
Okay, more than 14%. We also understand that the revenues did not account for the kind of copper prices rise that we've seen in the third quarter. So will we see that in your Q4 numbers?
See, as I explained that copper is, is a back-to-back arrangement with the customer. So, the 25% growth is consist of 2-3 things. One is obviously the impact of copper in that. But other than that, market has grown by 19% and we are growing by 25%. So one is the volume growth, and content is also growing into the business other than the copper price increase.
All right. And if you could give us a sense on the content per vehicle, any trend on that? How much was that about a couple of years ago, and how much is this now? How much is that likely to grow with your new products coming in? That's one. And secondly, your new greenfield units as well. They're ramping up. What's the capacity utilization there? And by when do they get to the ROCE that you have for the company level?
Okay. So first, coming on to the second part of your question, on the greenfield plants, if you see that one of the plant, Kharkhoda, it is already ramping up the volume and reaching to 80% capacity utilization very soon in Q4. The plant in Gujarat, Mandal, there are two projects, two powertrain projects which are under launch at this moment, and they will be also ramping up the volume by Q4 and Q1. And the third plant in Pune, which is around at this moment, is coming to around 50% utilization. Other than greenfield, most of our balance plants are reaching to the 80% utilization because there is a surge of the demand from the customer. And as a company rule also, as soon as we are touching to 80% utilization, we started doing the expansion into this. But they are backed by the customer firm order. So you will see in the future also that how we are going to, doing the expansion into the coming times.
You're doing the expansion, but what about breaking even? When do the greenfield units break even?
See, if you see the greenfield projects at this greenfield plants at this moment, there is a improvement onto the greenfield plants as well. Obviously, all these plants, we have to see the volume also. The forecasted volume given by the customer is the key into this. Though some of the volumes has gone as per the forecasted, but some of them are not. But we are very much positive because these capacities are fungible. So in case the new businesses are coming to you, you can always put these new businesses into these capacity and can run the plants.
Right. And you did not answer on the content per vehicle. What does it stand at right now? Where was it earlier, and where do you intend to take it?
See, at this moment in passenger vehicle also, you will see that most of the vehicles being sold, more than 60% are SUVs. And in these SUVs also, people are looking for the feature-loaded models. So once the feature comes into the picture, a wiring harness get a little more with a higher content into that. So it all depends. If the customer is keep choosing the higher, higher specification of the cars, then obviously wiring harness sales and content will be growing accordingly.
Could you give us a sense of what the average duration for your contract revision is like? And when does that start to show in your numbers?
Sorry, can you repeat the question, please?
What is the average duration of your contract revisions and this repricing impact? When do you think it'll start to show in the numbers?
See, these customer contracts are to the full life for the model. And so we work accordingly to on these contracts. But as far as the margins are concerned, at this moment, yes, sequentially you have seen a little pressure. But as we have grown 10.5% year on year also, so the idea is that to keep improving the cost, the manufacturing cost, and for that also we are doing an investment on the automation and digitization into the plants, where our focus is to improve the productivity and increase the process efficiencies, so that we can save the cost on the direct and indirect cost, and these margins can keep improving as the time goes by.
Right, electric vehicles, which were supposed to be the big game changer for the automotive industry, and a lot of players like yourselves also, wanted to be present in this via powertrains, etc. It's just about sub 6% of your revenue right now, and also that is the kind of proportion that it has in the overall market too. The street was expecting faster growth out there. Do you think there are reasons why that hasn't happened? And what is your own plan in terms of contribution coming in from EVs?
See, as you said that EV is approximately 6% of our this Q3 sales revenue, and this consists of passenger vehicle, commercial vehicle, buses, two-wheelers, and even three-wheelers as well. So MSWIL is already available, supplying to all the categories into the EV. And for EV, I can tell you that it is a more complex wire harnesses compared it to the low voltage. And we have to just see that in the greenfield also, if you've seen that one of the EV powertrain is getting a volume ramped up in Gujarat, and another one is launched as we speak right now. So EV penetration is there in the market. As a company, we are ready because we are already supplying to all the segments. So as soon as the volumes will come, we are a future ready organization, and we'll keep supplying as the customer need, whether irrespective of any powertrain.
And you don't have any target, aspirational target out here that maybe 10%, 15% or 20% should come in the next couple of years?
See, we have to listen with the to the customer requirement. That is very important. So if customer is looking for any powertrain, irrespective of EV or or ICE or hybrid, we make sure that whatever customer is looking for, we are ready for that. So there is no as such target for ourselves. It's driven by the OEMs. If customer is asking us to produce EV or to CNG or any powertrain, we are just ready ourselves for that, these 30 plants, which we are serving right now to these OEMs.
Anurag, just very quickly, the copper price hike, when will it be passed on? I think in the con call you did indicate that the pass-through will be with a lag of a 3 to 6 month window. So when exactly will it be passed on?
See, there is a pass-through arrangement with a lag of a quarter with a major customer, and in some cases it's a 6 months also. So you're just seeing that it's a matter of, it's a temporary phase at this moment. So
now we're currently about a month into the third quarter. So have you passed it on from the second quarter?
Yeah, obviously, if you see from the second quarter, if you compare it or year also, there is not a very huge increase. But yes, in Q3, you can see there is a increase of around 15% on sequential, and I think around 20% plus odd on year also. So the mainly impact in the Q3, which should get settled by the Q4 and further in the Q1 of FY27.
All right, take that point. Thank you so much, Anurag, for joining in and giving us all your internal details, etc. What we'll do is we'll circle back after a quarter to find out whether you've actually managed to pass it on without that having any impact on your demand and your margins going forward as well. Thank you once again for joining in. With that, we'll take a short break, and on the other side, we'll get you an interesting update coming in on the PSUs. The market continues to hold in the green while volatile, holding above 24,850 for the frontline index. 24,870 and counting on the Nifty, but the government has set 80,000 crore as its divestment target for FY27. The economic survey too had made a recommendation with regards to the government bringing its stake in multiple PSUs below 51%, and the DIPAM secretary told CNBC-TV18 on all possibilities that are on the table. What does that mean for all those of you who've invested in PSU stocks, and which could be the ones which could be privatized? Well, Hormaz joins in with a detail and the PSU basket. How much value can the government potentially unlock? Hormaz.
You know, every time the budget is presented, one major section that has been awaited keenly by the market is the disinvestment target. Now, this year, the disinvestment target has been set at 80,000 crore for FY27. Now, before that, the previous years, there have been ambitious targets that have been set, but the targets have not been met. Now, yesterday, the DIPAM secretary told CNBC-TV18 that the eco survey mentioned this point, right, that there is a possibility of the government bringing its stake to below 51% in a lot of these PSUs. These are very exciting possibilities, and everything is on the table. Now, when you say something like this, there always is this question that what happens when everything on the table does fall into place. Now, on this analysis, we have analyzed 84 PSU stocks that are listed. This includes companies that have government stake of less than 75% as well, which are in compliance with minimum shareholding norms, and also includes PSUs which have other PSUs as their promoters and not directly the government. Now, when you take a look at the companies as well, there are 9 such companies, PSUs, that have the government holding more than 90% stake still. There are 10 companies between 75 to 90, and most of the others fall in the 26 to 75% range. But when you take a look at the total value, the minimum stake that the government wants to hold in these PSUs, 26%. In a hypothetical scenario, the total value of the stake in excess of 26% comes up to well over 27.5 lakh crore rupees. Now, that is the total government stake, excess of 26% in a lot of these PSUs, and this is as of yesterday's closing. Now, which are these companies that we are talking about? Now, most of these companies, the more than 1 lakh crore value, there's 5 of such names. There are 12 companies that have value between 50,000 crore to 1 lakh crore, 14 companies which are valued between 25,000 crore and 50,000 crore. I'm talking about the excess government stake above 26%, that is. Now, which are those companies if you drill that down? You take a look at LIC, of course, the government continues to hold well over 96% stake in the company here, and that excess 70% that they own is still valued at over 3.5 lakh crore rupees. Follow that up with India's largest lender, SBI. There's almost 3 lakh crore rupees to be unlocked there as well. Now, HAL is the other one, almost 1.5 lakh crore. Concor finds a mention here, but that excess 54% stake comes up to around about 1.1 lakh crore. And of course, there is ONGC, which is of course more than 1 lakh crore rupees as well. I'd like to highlight one specific instance, which is IRFC. The stock has been listed for almost 4 years, but the government is yet to comply with minimum shareholding norms here. The stake still lies at 86.5%. The excess 60% that they own currently is valued at close to 90,000 crore rupees. But at the peak, when the stock was at 229 rupees, that stake was almost close to 2 lakh crore, and the stock is down almost 55% from those levels right now. But of course, the DIPAM secretary may have said that everything is on the table, all possibilities are on the table, but there are enough and more challenges. As you mentioned, that there are 9 such companies where the government holding is still more than 90%. So divesting such a large equity base is still going to be a challenge. Now, there are long completion timelines. IDBI Bank is a case in point. The disinvestment process began almost 5 years ago. It's still ongoing, and it may reach a completion by the end of this financial year. And the other major question is whether sensitive sectors such as the defense sector, the railway sector, should those be exposed to external shareholding? Of course, there are mutual funds and so on, but an external promoter or external control, should that be a question as well? So that is an important question to watch out for. But the government has said that everything lies on the table, and there is almost 27.5 lakh crore rupees that's still left to be unlocked.
Everything on the table, but Hormaz, disinvestment targets, I mean, the government has been missing them for a few years, and that 80,000 number this year as well looks like a bit of a challenge, so we'll have to see. Like you said, it's been 5 years in running on IDBI Bank. As we close, the market's in the green. Nifty up about 35 points. Sensex up another 230 points. The mid-caps, though, still under pressure. On that note, it's a goodbye from Mangalam and me. The next show will take all the action forward.